Well, we think, man. Good morning.
Good morning.
How you doing?
I'm living the dream. I feel much more disappointed now that my mug isn't worth hundreds of dollars.
Yeah.
It's only worth $6.
Well, it's funny. It's how do you know what something's worth?
Yeah.
Right?
Uh-huh.
And how do we figure that out?
Yeah. You got to dive into it and figure it out.
Yeah.
You got to look it up first.
Yeah. Our director, producer, Kelsey, hit the old Google button and found out it was worth
$6.
$6. So I look over here because, back in the grocery store days, when we got these Budweiser mugs in right here, it was a big deal.
Yeah.
People went crazy for them. I don't think it's as crazy nowadays as it used to be.
No, but it used to be a big deal.
You get in your case of Budweiser mugs, and people were asking, when are they coming? It's around Christmas time, holidays. And I'm looking at that mug, and it's 1991, so Kale's thinking,
maybe it's rare.
Maybe it's worth $200.
Maybe it's worth $200.
I'm slinging it around like it's worth nothing.
I put this in the dishwasher a lot of times.
Yeah.
It's not good for a collectible item. $6 doesn't matter.
So, yeah, made you feel a little better.
Yeah.
What would you have felt if it was $200? What would you have done?
Nothing different.
Nothing different.
I'd still done it. But then I'd have been dramatic and told everybody about how I'm drinking out of a $200.
You have a story to tell.
Yeah, I have a story to tell.
Yeah. Yeah.
This is actually very valuable.
Very bad. Values in the eyes of the beholder.
That's true.
Yeah.
It's not worth $200 to me.
Yeah. No. Well, hey, we have a great presentation that you did at the MVMA.
Yep.
Done it a couple of times. Kelsey put this presentation together for you. And as we are sitting here in the 1st of March with this podcast, it's, are you profitable? Mm-hmm. And that's every month you'll be looking at it. But able to have some data from last year on how things went, and also looking at this year. And I think that has so much importance to how people think about profit, numbers, and pricing. That mug right there is that people don't know, and they make assumptions. They don't look at data on pricing. Yeah. And they actually price out of probably fear more than anything, right? Mm-hmm. I'm fearful that someone's going to be pissed at me. They think I'm charging too much. Mm-hmm. So all those things go on. So what's really good about this, and I'm excited for you to share it today, is that the data's there. It says there's work to be done.
Yeah.
And so, yeah.
Yeah. No. So,
are you profitable?
Are you profitable?
Are you profitable?
I'm sure we can throw the slides up. But, when I did this at MVMA, I'm going to try really hard today not to say multiple times.
Okay. So you me stop you if
my
you do?
Speech mannerism that I just need to get rid of. However, when I gave this at MVMA, the first slide here was blank, and I asked everybody, I said, what do you think of when you hear the word profit? Mm-hmm. And people in that room were generally positive, which I wasn't expecting, because normally you hear everybody thinks profit, and it's like evil corporate greed, right? That's the stigma that comes to that. And so I threw some things up here, and I tried to have a good mix of that. But, some people might think financial freedom, greed, overcharging, guilt, going on a vacation, buying a boat, taking advantage of other people, sacrifice. Mm-hmm. And those are all valid feelings that people could have.
Yes.
When you're thinking about profit. And so it's really a mindset thing when you approach, I'm making money, and that's not a bad thing.
Yes.
If you're making maybe an egregious quantity of money and exploiting people and things like that, it could be bad. But most veterinary clinics, it's not a bad thing to make profit.
No.
So,
well, hey, that's the other thing about, you talk about mindset with that, but also we talk about data. The data can show if you're making, I hate, weird to say making too much money where you maybe are overcharging, right? Maybe that is egregious, and that can show you in the data that, that is, because there's metrics out there that say here's what's appropriate.
Mm-hmm. The market would price you out, though, if you were being too egregious, I would think.
Potentially. Depends where you're at.
That's true.
I mean,
you could be in a desert.
Why I say that, because I think you can look at it. The numbers will help you either way, right? So, yeah.
Yeah. So, but that question of why are you profitable really comes from people looking at financial statements and not being able to pull things out that aren't normal. And so
you've got a great line on here.
Yeah, the question is, where can your financial statements lie to you? And so going through this, and I'm not going to go super in depth, but the first one is rent. And so if you're approaching this from the standpoint of looking at your own practice, the question you need to ask yourself is,
you own the building.
You own the building.
You own the building.
You're renting from yourself. You own your practice.
Okay.
But even if you don't, to a point, you can understand whether you're getting a deal or not too. how much are you paying in rent? And so the generally accepted, like the market standard out there, you hear 6% a lot. The average is 4 in this data set. And so I've seen it as low as 2, and we'll see the difference between mixed and small animal clinics.
Midwest data set.
Midwest data set.
Midwest data set.
Yeah, and so what that would tell me is if you're paying yourself 8 or you're paying yourself 2, you're either overpaying yourself on rent and you're less profitable. And, that's a good thing, you know, because your net income, your true normalized net income would be higher. Or, if you're way underpaying yourself, that could be a bad thing when it comes to net income. You bring it back up.
You use that word we talked about not using.
Yeah, fair.
Normalized. But hey, real quick, let's use that word as what that means is what the bank accepts for lending. I think that's what that means is the bank is going to say, I'm going to treat these numbers as if, that everything was normal.
Everything was normal or paid right based on standards.
Yeah. They're looking at it as an investor that's not going to have labor in that practice to go, what would it take for me? Because as the bank is looking at it going, what happens if I have to own this business, right? Because that happens.
It does.
Very rare, but that happens. If the bank has to own that business, what's it going to cost me to own that business? Because the owner isn't there anymore, or I got to pay that owner as an employee now. And so that's what they look at when you say normalize. So really, you're right. We talked about that. It's a hard word to get out there as people get
it's a hard
lost.
word to make
What does
sense.
that mean? But really, it's like, what's acceptable to the bank?
Yeah. And I think it's an important concept to know, though, because when you're approaching this conversation through trying to understand the value of your practice, if you don't understand how to make numbers normal, then your value, you're not going to be able to calculate your own value. And so I think it is an important concept to understand as well.
Yes. Break down why do we talk in percentages in the profit and loss versus dollars?
Because it's applicable across companies.
It's like if you're in New York City where cost of living's high.
Yeah. It'd still be a similar distribution likely where, it might be slightly different.
Versus here in Columbia,
Missouri, it would be a similar percentage-wise.
Percentages
and also it makes
translate.
sense, I wasn't going to say that. If you make $1 million a year top line and I make 4, if we're just talking about dollars, it doesn't translate. Whereas the cost of goods sold percentage would still be likely the same. Labor would be the same. Distribution of services would be the same.
Also important to look year over year with your numbers to compare yourself to yourself.
Yes, 100%.
To be able to compare yourself to yourself and the progress you make. So that's good. Well, I think as we dive into that though, let's set the stage on those percentages. So
yeah. So coming back to where financial statements can lie to you, not paying yourself as a veterinarian appropriately, which I'm not saying you should or should not do based on what your CPA has told you. However, if your production calculation says you should make $200,000 as a veterinarian and you make $100,000, your net income is overstated by $100,000.
Right.
And so that might be fine for the IRS and the tax guy, but when it comes in time to do evaluation or to understand are you truly a profitable clinic or not, that is something you need to definitely take into consideration. So the other things that come through that are not always a big deal, but could be are bulk orders that you expense out in one year or the other. So like you might look profitable at the beginning of a year because you bought a bunch of stuff in last year and expensed it out and things like that. There's ways to check on those things. Lots of folks, like I said, that kind of ties into not paying yourself as a veterinarian. They might still take a draw, but your draw is not categorized as an expense. And so you might make $200,000, but it's not on the profit and loss statement. And so it's not reflected accurately in your numbers. Also, a lot of times we'll see miscategorized transactions if somebody is doing the books, not intentionally, but they just may not have any clue where to put things. And so they end up going in a general bucket, but it's like loan payments that just get put on the profit and loss statement. The interest is an expense. Principal is not an expense. And so those things can get overstated that way or understated. And then if you bought an asset, it doesn't belong on the profit and loss statement. I wasn't going to say that. The CPA can put it on the profit and loss statement through depreciation and such. However, the whole purchase doesn't just get, if you bought a $30,000 X-ray machine or whatever, you don't get to just expense $30,000, or you shouldn't. And then tax payments / payroll, depending on how you're structured, your estimated taxes aren't an expense to the company, likely. And so if you're just throwing those on the profit and loss statement, it might be decreasing profitability, or, if they're supposed to be on the profit and loss statement, they're not, that can be a problem as well. So those are just a few places that your financial statement could lie to you if it's not being done well. What would you add?
No, the setting up the stage for that's great. And getting back to what you said, I love the question about get back to that slide there, where can your financial statements lie to you? Mm-hmm. That's it. That's people come in sometimes with a financial statement, think they're in great shape. And if you correlate this to the veterinary community, imagine if your, blood machine analysis isn't working, is off, and giving you false numbers. Imagine if your, thermometer taking the temperature of the animals off by a couple of degrees. Mm-hmm. I mean, I think it scales off. I think that's what's going on with people's numbers is that, yes, we have these AHA chart of accounts, but great.
Just because it looks pretty doesn't mean that it is.
Yeah, that doesn't. It's a complex thing. Mm-hmm. I think that's if we can do a pitch here with DVM Office, what you do so well there, what your team with Anna, Austin, Lane, with Sam and JT on the technology side of automating, integrating, accuracy checking to make sure things are going to the right accounts. Mm-hmm. It's as accurate as it can get.
Yeah.
So what you're looking at is right. And I think as we've done this, as we've seen profitability maybe actually shrink to a degree.
Yeah, certainly.
On people. Cash flow is still the same for clients, but profitability when you first go through this process, like, oh, I do have work to do. Mm-hmm. Whereas the blood machine, like if it kept spitting out the right stuff going, and then all of a sudden come in like, oh, mm-hmm. I got a new blood machine, and I'm getting different results. That's the way to put it, right?
New blood machine, different
blood
results.
Machine does the right things with the thermometer, getting everything calibrated.
Right.
That's what it is. So man.
Important question.
I know we said we wanted to do short time, so we'll keep rolling here.
Yeah.
Yeah, because I'm going to geek out on.
We could talk. I talked to
statements.
I talked to MVMA for an hour and a half.
Awesome.
Because the room was open at the end and people stayed. But no, it's a good topic. So the next slide here, understanding an income statement. Mm-hmm. Really, it's made up of just a few big pieces. So the tax return is going to look at very few things. That's not all of them, but that's the majority of them. And so also, if you look at general benchmarks, which I absolutely despise, because I think that it's unfair for you to compare yourself to anyone else largely and say that I should be at that number. There's a range. You should be between a range, or something like that. But it's not like if you're not at 20%, you're failing.
Yeah.
Like that's not the stance that I would take on that. But anyway, if you look at a general makeup of the industry standards, you would start at the bottom of the income statement and say 20% of that should go to net income. 15% of that will go to, this is every dollar that comes in the practice. 15% of that goes to general expenses, rent, cleaning the floor, lawn care, whatever it is. Mm-hmm. Labor, obviously the biggest one, going to be roughly 40% once you include everything, benefits and whatnot.
Payroll tax. The employer pays.
Yep, all the stuff.
Payroll tax.
And then cost of goods sold should be somewhere around 25%. So and I'm going to completely contradict some of these things here in the next slide. But the whole point is, if you go out to the industry, whatever that is, and you read articles and you look at things, you're going to come to an answer that is somewhat similar to this. Mm-hmm. If you just put a practice in a box, that's what they say you should get to.
Yes, and that's what. When you get back to those AHA chart of accounts, all those things, people self-report to AHA.
Yep.
They say they're doing some integration stuff, but at the end of the day, how do you ensure the data is good coming in?
Mm-hmm. Absolutely.
So, yeah.
So I took 20 of our clients, and I took 10 small animal and 10 mixed animal, and I removed people that had strange anomalies. So this is a very, what I would say, fair representation of a data set. Now, I want to reiterate, these are not what we had a conversation earlier on normalized numbers. These are not normalized numbers. These are as reported to the tax return. Mm-hmm. So,
two main things on normalization. Usually, there's two things. It's the owner's
underpaid.
Pay as a veterinarian is underpaid, and then rent.
Yeah. Rent's probably fair. Rent's probably usually pretty good.
Sometimes
Sometimes
you
can
see
be
it 2%.
Usually the
2%
biggest
something.
one is always
Labor.
owner pay. Almost
Owner
always
production pays a veterinarian.
Yep.
Is underreported.
is underreported. Yeah. So this was so for small animal clinics first. If we look at that, net income is obviously less than 20%, coming in at about 10%. If we average everything out across, cost of goods sold is way higher than what it should be, based on averages or based on industry standards at 33%. Labor is pretty close at 42, a little high, but that could, there's ways that would be reasons that could be the case. Expenses right on the money, 15. I think that one's probably going to be the most fair representation because it's close. It's very close, and it doesn't change a whole lot. Like there's only so many things that a vet clinic buys that would fall into that bucket that would make that change differently. And so that's kind of how the small animal data set, comes into play. The one thing that I will say is I think everyone is less profitable in 2024 than they were in 2023. I don't have the data on this sheet specifically, but it is less. And I attribute that to not keeping up with inflation pricing.
Correct.
So
yeah, what's happened is that when the company goes, we're increasing prices 10%, the veterinarian increases prices 10%. It decreases your profit. You have to go more than 10. You have to go 10 plus your profit margin into that. And so that's the big part. It's like, well, if your profit margin needs to be, if 75% is your profit, 75% needs to be what you're going up on top of the 10%. So you really probably need to be going up. If you divide 10 by 0.75, you're going to get like 19%. You need to go up by 19%. That's tough.
Yeah.
It's tough for the veterinarians to handle, but a good correlation of why they should do this is Aldi's. We shop there, and family of 5, and our bill in the last 2 years has gone from 100 to 180. Double.
I think a lot of times too, what I've seen is clinics will just eat the cost and say that's okay. I'm not passing it to my customer.
They get to choose that.
And that is a choice.
They get to choose that, right? Well, you got to respect that.
Yeah,
they do.
But it's why net income is less.
It's correct.
So,
right.
Coming in at mixed animal clinics, and I'm not going to talk about the differences on this page because I have a differences slide, but net income as reported is 11%. Again, I think this one is likely more overstated because of labor than in other places because the mixed animal travel component, lots of things that can go into that argument. However, you'll see a swap on cost of goods sold coming in at 39 and 37, and then expenses are 13. And the 13% is rent because mixed animal clinics generally pay themselves less rent than small animal clinics in this data set.
Yeah. Oh, because they're kind of ambulatory too, right?
Yeah.
Maybe they don't need as big a facility because if they're doing revenue out here, half the revenue's out on the farm.
And you can say that you can make the argument that it's more a rural environment where cost of living is less too. So
maybe the rent is right because of that ambulatory part.
Potentially.
Yeah.
So anyway, that is what I attribute the majority of that change on expenses to. So
could have a whole episode on, what are you charging to drive out to that farm?
Oh yeah, I don't want to get into that. There's lots of opinions about that. I was nervous talking at MVMA about that. I was like, hey, should you go? Like maybe.
Hauling?
Yeah, or
even just you don't need a hauling. You have a chute. Have them come set up a fence and use your chute on your property.
There's certainly a demographic of folks that certainly need to be served. But if it costs you money to serve them, that's your choice.
Yeah. Well, it gets into that why profit matters. On the one side is that to be profitable, to be able to serve somebody, you have to be profitable. Because there could be that call where you're like, so-and-so have been 3 generations of farming. They're a small operation. I really care about them. They're trying. I want to go serve them. You better have profit
on the other side
to go because you're not going to make profit on that, which is fine.
Yeah, and I totally advocate for people, not everything has to be profitable.
Yeah.
It doesn't. I mean, if you're making plenty of money and you're happy, that's what is important. And so I'm not here to say whether someone should or shouldn't do something, but if you're trying to be as profitable as possible, you can't do something that costs you money on purpose, or at least know that it doesn't cost you money and actively make the choice to do that. So, where moving on to like the differences. Cost of goods sold comes in right at 6% higher at large animal clinic or at a mixed animal clinic than it does a small animal clinic. I already talked about facility expenses being 2% less at a mixed animal clinic. The average allocation, which I think this could be its whole own topic, and this was a pretty large disparity, so I would take this with a slight grain of salt. But the average of these 10 clinics was 24% of revenue was attributed to large animal services, whether that be equine, cattle, whatever that ends up being.
So of the mix of revenue.
Of the mix of total revenue, 75% is still allocated to small animal.
Okay.
And so there were some folks that were 55 and some that were 5. So that would still classify themselves as a mixed animal facility.
Yeah.
So large disparity in that. I'd like to get more folks in that data set to understand maybe, is that truly the percentage? I think it's close, but I'm not willing to sit there and say it is 24. It could be 20 to 30 would be a good acceptable range.
So what this comes down into, where percentages do change, is that if you have a bottle of Draxxin, it's $1,000 cost,
Roughly.
You cannot mark that up 2 times, 3 times. You can't. You're going to mark it up $200, maybe. But you are making, so it's like you're making $200. So that's on one item. It's smaller percentage, but you're still making money. So the way that rolls out is your labor rate should go down because you're getting a higher dollar item per labor. So that's where, yes, my gross profit declines a bit as a large animal potentially, but my labor declines also proportionally. And we saw that between 3 grocery stores in 3 different towns based on what people bought. One town, they bought things that were less profitable, but higher volume, and then your labor was down, vice versa. Kind of interesting the way that'll work out. So, yep.
So also looking at that 13% of income at mixed animal clinics was allocated to large animal cost of goods sold.
Yeah.
So that's a pretty high expense ratio there if you go average that out. Labor at mixed animal practices 5% less than at small animal.
Okay.
So
okay, yeah, no, that's what net proves that right there. So look at cost of goods at +6, labor at -5. That almost proves out that point right there.
There's the swap. Yep. So anyway, Stephen, you can
strategies.
Yeah, you can talk about profit optimization strategies. There's really 3 main ways you can change that if you have an issue. But
yeah, no, definitely. Obviously, in any business, it's your number one thing should be revenue. Do you have revenue coming through the door?
Yeah.
And that's at the end of the day. If you don't have revenue coming through the door, there's not much you can do. And so really focus on revenue, and great points here through to go look at. What is something that you can provide that's best medicine for the animal that would be new to your practice, or something that you have already that you're not optimizing? Whether that's, I think dentals, a lot of people, it's interesting. You used to have dental month in February. It was a big deal. Seems like it's not as big a deal anymore.
it's still around.
It's still around, but it's not like pushed like it used to be because people are like, I don't want to shove all the dentals into February. But I think we're missing a little bit on dental again. I think it's not in the people's minds as much. Something as simple as that, the dentals. Revenue, how you do it, too, is in that practice, in the exam room, is that you make sure you're communicating the services well. So you get what is best. I cannot talk right now. I have a brain fart. Getting ready to fly out today to Vet Partners and Western. I'll leave it 5.
Gotcha. So
I have to do a meeting from the airport though because to get the meeting anyway. So I apologize. Yeah, no. But back to this. Thinking about it in the exam room. Really communicating again the services that need to happen for the health of the animal matters, and don't make the pricing decision for that customer.
Option A, B, or C.
Yeah,
most people go with B. Too, by the way. Here's best medicine. If you don't like that, here's this. If you don't,
but you're going to get a lot more people going A than you ever thought before because you're probably recommending B or C.
Yeah,
you never recommended A because you're fearful that someone's going to think I'm high priced.
Yeah. Anyway,
give them the option. So no, there's that. I think that. So let's say we got revenue coming in. All right. If I look at a practice and I see revenue's good, but profit has an issue, then yeah, it's going to be cost management, and cost management is real simple. At the end of the day, it's between labor and cost of goods sold. The two biggest things you said. Your fixed expenses, your rent, utilities. When I say fixed, utilities fluctuate, but those things like that, you're not.
They're not changing. Don't. Well, I mean,
is it 74 in your practice or 72? Like you can do little things like that. Save $10 by dropping
but like
the
who
thermostat.
cares? It's $100.
Yeah. Well, it all matters.
It does.
It all matters. It adds up. You got to have that. You got to have that thinking about cost effectiveness. And when why you do that? Because it gets you in that cost effectiveness mode. So when you're thinking about a business, that's what you should be thinking about. And so, you're looking at your inventory, looking at things that go, am I overbuying? All the things that goes on with that. And at the end of the day, too, it's just talking with your vendors. I don't think people forget you have to ask the question.
You do.
You can't. No one's going to help you unless you ask for help. That's the end of the day. When you sit there and just wait for help, it's not going to come to you. But if you ask for help, the vendors want to help. When you ask, they will. They will help. Say, I need help on my pricing, or help on my cost controls. I need you to come in and see me. They will. They'll come in and train. Come in and buy your staff lunch. Multiple things they will do. They're looking to do that. Because that's justification for that salesperson's job to go, hey, I was at that practice. I helped them out. I did those things. So that's good. Pricing strategies. What's difficult on pricing strategies, one is maintaining the cost of goods sold with the cost from the invoices. So I think what we like to take an approach on to simplify it is to go the 80-20 rule, that 20% of your services, products generally come 80%. It's a little different. It's more like a 40-60 rule in the veterinary space, where 40% about 40 items end up being about 40%. We've kind of found that ratio actually. 40 item services between services and products end up being about 40% of revenue. So if you go look at those 40 and make adjustments on those 40, you should be able to get your profit up pretty quick just on 40 items. If you got any questions on that, please give us a shout. We can help you on that strategy real easily. But revenue, cost management, price strategies ties back into the graph that you have, the pie graph, about how it breaks down. What's the biggest categories?
Yeah, labor and cost of goods sold.
Labor and cost of goods sold. Got to get right in there. So good stuff. Anything else you'd?
No, I mean, just to kind of clarify some of those things, just really quickly. Under revenue, the things you can do to look at that are ask yourself the question, what new services can you provide? You got to ensure that all the automated prices that are in your system are correct and actually being multiplied, right? Because that has happened before where the PIM system's just doing it wrong. Guard against inflation with your life. Make sure that you're not, losing profit margin to inflation constantly. What services could you get rid of? I think that's always an important question to ask yourself. What are you doing that's totally not worth your time to do? And are you incentivizing your staff to sell for you as well? Because I think that's an important. Everybody has to be saying the same message. You can't get a message from the front that you get different in the back. So, just some very specific pointed things to do there.
Services, like real quick, are you doing grooming and boarding?
Yeah.
What's that?
What's it doing for you?
What's it doing for you?
Yeah.
Okay.
I think it's always important to be critical about your services. Like,
yeah,
what is truly worth doing and what isn't. So, this graph I put on here solely just as a kind of a reference point to say. Yeah, perfect. Just as a reference to say, look at if you put your top line revenue on a graph, understand what months you're making it over time and what months you're not. And I would argue, I would bet that you will find the lowest month or the lowest 2 months of the year are always the same 2 lowest months of the year. If you look at this graph in particular, September is particularly almost always flat. Those are 2 separate years right there. And so the question that I ask myself in this whole scenario is, if I'm going to take a vacation as the owner, I'm probably going to do it in September. Or on the flip side of that, what can I do in September to raise revenue that would be different from other months? And so you might also use your high volume month of August to come in and say, hey, let's open up extra surgery time. Let's open up extra slots for services that we may not offer normally, but we know that September's not going to be as busy because the last 3 years it just hasn't been. And so we can schedule differently because of that. Or maybe, in May, July, and August, based on this graph, we open up extra appointment slots in a day we stay open an hour or two later. I'm not saying you should, but it's a question, right? If you know you make the most of your money in 3 months of the year, let them come all in right there. I mean, consider it.
Yeah.
So just ways to look at the graph and ask yourself some questions. Like if you could bring every month to a line, how would you pull that off?
Other important part about financial planning and forecasting are tracking key events.
Yeah.
If you look at January on here, without diving into it year over year here, I'm going to say the year that's down had weather.
Yep.
Had snow. Could be February. February's pretty stable there, so it looked pretty good. March, pretty good. April, it's increasing, right? And, then you get into May, June, July, and you go, you took a vacation, or 2-year veterinarians took a vacation, didn't they?
Yep.
In July, in your highest revenue month. You took a vacation.
Yeah.
And then we know August gets to be the dog days of summer. But people looking at school, they're going to take care of some animal things before they get their kids back to school and get busy and can't get to the veterinarian, which September, if I look at September, we've had a discussion that it's going back to school. Mm-hmm. People are busy. Fall sports, kicking that off. The routine is just like to get the pet to the practice is a tall order. So understanding all those things. The back to school special. Mm-hmm. How can you market it and make a difference? But you have to know events. Now, you have these numbers here. Then what events have happened to affect your numbers?
Right.
Sure.
Absolutely. So, just to kind of wrap it up, why would you care about net income? If the first question I would say is, are you happy? Are you able to do what you want to do with your life? Mm-hmm. If the answer to that is yes, then the only other thing that would be important to do is, you're looking at a sale at some point of the practice. And so net income is obviously a big part of the value of the practice. The calculation, the word EBITDA, you need to know the word if you're going to go sell that, research it, at least understand that before you go to the bank. If you say the word EBITDA when you go to the banker, they'll fall over in their chair, I have a feeling. But understanding that phrase is going to be largely beneficial. And so that's how whatever that number ends up being is what you take times a multiple, and that range can be anywhere from 2 to 15%. I mean, depending on whether it's a private
times.
15 times. Sorry, yeah,
No,
15 times. And so, whether it's a private sale, small clinic, or a corporate sale at a giant clinic, the better, the more profitable you are, the higher multiple you deserve. And the higher the multiple, the person can pay you for it. So it's an important concept to pay attention to as you're looking at a sale, particularly. It matters.
It does. Well, what it matters too is that you talked about financial independence in the beginning. Profit. People saying financial independence. That's how you become actually financially independent. Mm-hmm. Is the sale of your practice. Yeah. Hopefully, you've been saving money along the way, 401k or other things, and so you have. You're not relying completely on your practice for sale for your retirement, but it's going to be a big chunk of your retirement.
Right.
And you're going to turn off your income stream, so you need to make sure that can happen. And that's financial planning matters in that. And the earlier you look at it, the more often you look at it, it can really make you go, this feeling I have of feeling good is good. Mm-hmm. It's like, I back it up with numbers. Other things it tells you, too, is that generally a practice that has... When you talk about those multiples, why do they range so far? So swing so much is marketability of the practice, sustainability of the practice. And so the better your practice is for a bank, the associate maybe buying your practice, those things, they're going to go, oh, wow, your practice is going to continue to be profitable. And that's a well-run business. And so that's important to know that EBITDA can reflect a well-run business. The multiplier is where it gets a factor. Mm-hmm. It's factor. So not only am I profitable, but then this multiplier, that reflects I've got a well-run business, someone's excited about my location, what I got going on, the future of the area. There's a lot of things to understand. Mm-hmm. So we've seen both sides. We see at the MBMA where have the 72-year-old veterinarian come up and say, how do I sell my practice? And they're in a small town in Missouri.
They have one doctor.
And you go, well, if we had 5 years, if we would have gone back 5 or even 10 years, you've got to work on that a decade out, and just a little bit, right? I think that's the thing too. It's not heavy lifting 10 years out. It's just making little steps so you don't have it all stuffed into
1 year.
1 year, or it could be too late. So, as we've talked about, mindset is the future thinking, forward thinking. All those things matter as a business owner, and so really the practice valuation. Where numbers lie to you is when people will take their net income, and they'll take. Oh, I've heard times 5. I've heard times 10, but they don't understand the EBITDA, the standardization, what it looks like to actually get to that valuation number. And so, yeah, I think that people have to jump into it. So, yeah, are you profitable?
Amen. Are you?
We'll find out.
Guess you are.
Yeah, if you want to find out,
Call us.
give us a shout. There are, and if you're not in our neck of the woods, we work around the country, so don't be fearful of that. We're working remote with a lot of people, and really help out. We're here to help. So if you just need some questions answered, please give us a shout. Otherwise, no, it's funny. I love geeking out on this. I know a lot of veterinarians, they probably want to hear about, advances in technology for medicine and procedures and things like that. So really, though, if you're a business owner or wanting to be a business owner, I hope this does pique your interest, because it's a huge important part. It should excite you, but you shouldn't also feel. I don't want you to feel discouraged. You're like, I feel less informed now.
Yeah.
You could come out here and go, what did these guys just say? Mainly me. Kale laid it out really well. But what did these guys just say? And if that's the case, let's talk. Let's talk. So, good. Great presentation, you guys. Thanks for bringing that to the forefront.
Thanks for building it, Kelsey.
Yeah, Kelsey.
I gave you a very minimal little amount of notes, and you created something really awesome.
Worked out wonderful. So,
Perfect.
cool. Thanks, everybody.
Peace and blessings.
See you.